Welcome to TalkTickers. We dive into earnings calls to pull out the essential insights for, well, experienced investors like you.
And today, we're digging into Dime Community Bank Shares, Inc. That's ticker DCOM, specifically their first quarter 2025 earnings call.
Right. So the plan is hit the headline numbers first, then explore what management says is driving the performance, get their perspective, and look at the outlook for the rest of the year.
And of course, we'll wrap up with our This Is Not Financial Advices segment. Got a potentially interesting trade idea brewing based on all this.
Always look forward to that part. Okay, let's jump in. The results snapshot. What stood out?
Well, first off, adjusted EPS saw a pretty significant increase. We're talking 36% quarter over quarter and a big 50% jump year over year.
Okay, but there's a catch there, an exclusion.
Yeah, that's excluding the one-time impact from terminating a legacy pension plan. So a strong core performance underneath.
Got it. And what about the net interest margin, the NM, always key for banks?
That also looked good. The reported NM expanded by 16 basis points. It landed in the 2.9% range.
And if you strip out some accounting noise.
Right, excluding purchase accounting accretion, it actually rose even more, 19 basis points, up to 2.94%.
Nice expansion. So what was behind that? What fueled the margin growth?
Primarily, it was about the cost of deposits. They really managed to bring that down.
How much did it drop?
It decreased to 2.09% in the first quarter. Pretty significant move.
And that drop in deposit cost, how did it flow through to overall profitability?
It had a big impact. Core pre-tax, pre-provision income, PPNR, jumped significantly, hit $46 million
Compared to
just $28 million in the same quarter last year. So a substantial rise.
And that translates into?
That translated into a core return on assets, ROA, of 0.77% for the quarter. Solid number.
Okay. You mentioned deposits being key. Was there growth on that side too?
Absolutely. Core deposits saw a really notable year-over-year increase. We're talking $1.3 billion.
That's substantial growth in core funding.
It is. And it allowed them to cut back on broker deposits, get those down to minimal levels, and also reduce their FHLB borrowing. Better funding mix.
Makes sense. And on the asset side, loan growth.
Business loans showed good momentum. They grew by over $60 million just in the first quarter.
And year over year?
Year over year, that's up $400 million. So steady progress on the business lending front.
Okay, let's dive deeper then. Starting with those deposits. You said costs came down to 2.09%. How did they achieve that $1.3 billion core growth?
A lot of it comes down to hiring they've done since 2023. The deposit teams they brought in have built up portfolios now totaling about $1.9 billion.
Wow. So those hires are really paying off on the deposit side.
Seems like it. And that growth is what let them shed the more expensive funding, like those broker deposits we mentioned.
You mentioned Q1 is typically slower for deposit.
It often is, yeah. And they also had a sort of one-time fluctuation with a large title company deposit moving out right after year end.
Oh, okay. So adjusting for that.
Adjusting for that, the underlying growth in non-broker deposits was still strong, around $250 million for the quarter. The pipeline looks healthy.
And looking ahead, are they focused on keeping those costs low? What's the strategy?
Definitely. Cost discipline is a major focus. They're aiming to keep money market accounts below 4%. And want the overall cost of deposits somewhere in the, let's say, 2.25% to 2.5% range.
Are they actively managing the mix?
Yes. They made a conscious decision, for example, to let go of a higher cost municipal deposit relationship, about $250, $300 million.
And replace it with?
Replaced it with lower cost business deposits. So it's quite strategic. They're not just chasing growth, but quality, lower cost growth.
Okay, shifting over to the loan side. Business loans grew, but what about the overall picture, the pipeline?
The loan pipeline has actually expanded quite a bit. It's now standing at around $1.1 billion.
That's up from?
Up from about $750 million back in January. So good momentum there.
And the yields on those potential new loans?
The average yield in that pipeline is sitting at 7.22%. Pretty attractive in the current environment.
What kind of loans are we talking about primarily?
The focus seems to be on C&I, commercial and industrial, plus owner-occupied CRE and healthcare lending.
Any loans already approved and just waiting to close?
Yep, about $200 million worth. They're approved, just waiting on paperwork, basically. And those carry an average yield slightly higher, actually, at 7.25%.
But despite that pipeline, net loan growth was kind of flat in Q1, right? Why was that?
That's true. While business loans grew, they saw some runoff, some attrition in their commercial real estate and multifamily loan books. That offset the growth.
Is that expected to continue?
Management expects that attrition to moderate. They're forecasting net loan growth to be relatively flat again in Q2, maybe slightly down, but then pick up more significantly in the back half of the year.
Okay, back to the net interest margin. That 2.90% base and IM in Q1, excluding the noise, you said Q2 looks pretty stable around that level.
Yeah, that's the guidance. Range bound, maybe plus or minus 3 basis points around that 2.90% level for Q2, so holding steady near term.
But the really interesting part seems to be further out. That backbook repricing opportunity sounds quite significant.
It really is. This is probably one of the key potential drivers for them going forward. They have a huge chunk of loans, about $1.95 billion.
Okay.
That are either adjustable or fixed rate, currently yielding only around 4% on average. And these are set to reprice in the second half of this year and through 2026.
And the potential impact on IN?
Based on current forward rates, they estimate something like a 35 basis point increase to NIM just from this block of loans repricing higher.
Wow, 35 basis points is a major lift.
It is, and it doesn't stop there. There's another $1.75 billion block of loans currently yielding about 4.25%. That reprices in 2027. So it suggests continued NIM expansion potential beyond 2026.
So that's a multi-year tailwind potentially.
Yeah.
What about Fed rate cuts? How does that play into it?
Well, that could be another positive, potentially. They estimate that each 25 basis point cut from the Fed could actually benefit their NIM by about 5 basis points.
Interesting. So rate cuts aren't necessarily a headwind here.
Not necessarily, assuming deposit betas behave as expected and competition stays rational. It adds another layer of potential upside to that core repricing story.
Okay, let's quickly touch on expenses and capital. Anything major to note on the expense side?
Core cash operating expenses, excluding intangible amortization, were about $57.9 million in Q1.
And there was that pension item.
Right, about $7 million in non-core charges related to terminating that old pension plan.
Did they update their expense guidance for the full year?
They did. They nudged it up slightly. The new range for core cash non-interest expense is $236.5 million to $237.5 million.
Why the increase?
Primarily due to the new hires they've been making to drive that balance sheet growth we talked about, investing in people.
Makes sense. And capital levels. Still strong.
Very strong. Common Equity Tier 1 ratio actually increased to 11.1%. And the total capital ratio grew to 15.7%. So they're very well capitalized, giving them flexibility.
You mentioned hiring driving up expenses. Tell us more about that recruiting push and any expansion plans.
Yeah, they've been quite active, clearly focused on bringing in talent to grow both loans and deposits. They highlighted some key hires, like Tom Giel, who came over from Sterling, experienced banker.
And expansion into new areas.
Yes, they announced plans to move into the Lakewood, New Jersey market. Apparently, they see strong ties back to their existing Brooklyn community base there.
How quickly do they expect these new hires to contribute?
On the deposit side, they think it's relatively quick, maybe break even within 6 months. Loan generation naturally takes a bit longer to ramp up.
What was the focus of the Q1 hiring? More on loans or deposits?
Mostly loans. They said about 70-80% of the Q1 hires were in loan generating roles. Shows where the immediate focus is for asset growth.
Okay, important piece. Credit quality. How are things looking there? Any concerns?
Credit quality seems pretty stable, actually. The provision for losses was $9.6 million in Q1.
And charge-off.
Net charge-offs to average loans actually decreased, down to 0.26%. And the allowance coverage, the ALL, ticked up slightly to 0.83% of loans.
Any specific problem loans being dealt with?
They mentioned exiting one legacy bridge loan they'd previously flagged. And they have another classified loan under a purchase agreement, expected to close in Q2. Management seemed pretty clear. No systemic issues apparent right now.
How about the CECL model? Any changes there?
No major changes to the model itself. Still using Moody's forecasts. They do expect the provision expense to trend up gradually over time, though, aiming for that allowance to eventually land somewhere between 0.90% and 1% of loans.
So, summing up the guidance themes, management sounds pretty bullish overall.
I'd say cautiously optimistic, maybe bullish on specific areas. Definitely confident about continued NIM improvement over the medium to long term, driven by that repricing.
And balance sheet growth.
Expecting that to pick up pace in the second half of the year.
Expenses slightly higher due to hiring.
Correct. And fee income guidance at $42 million for the year seems to be holding steady, though some swap fee revenue expected in Q1 might shift to later quarters.
Did they comment much on the broader macro picture? Fed moves, tariffs, that sort of thing?
They acknowledged the Fed cuts could impact NIM, but as we discussed, potentially in a positive way for them. They see the current rate environment as generally rational for pricing loans and deposits.
Any specific sector concerns?
They mentioned monitoring potential tariff impacts, but feel their direct exposure to import-export or heavy manufacturing is limited. They are keeping an eye on services and construction, though, within their markets.
Okay, so bringing it all together for an investor looking at Dime, what are the key takeaways from this call?
Well, first, the core deposit growth is real, and it's successfully lowering their funding costs. That's a fundamental positive.
And that feeds directly into M.
Exactly. And the NIM story has legs thanks to that massive backbook repricing opportunity coming up over the next couple of years. That's probably the key factor to watch.
The hiring push signals growth ambitions.
For sure. It signals an aggressive strategy, especially in business lending and maybe that new Lakewood market. Yes, it means higher expenses now, but it's clearly an investment for future earnings.
And they have the capital to support it.
Plenty of capital. Best-in-class ratios give them flexibility. Although they mentioned weighing share buybacks against using capital for loan growth right now, especially to manage CRE concentrations.
So management seems confident they can get to a structurally higher level of profitability.
That's the message they're conveying. Confidence in achieving higher NIM and better earnings power, even if rates eventually come down. That's definitely worth noting.
All right, let's pivot to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based on Dime's Q1 story.
Okay, let's think medium term on this one, really keying off that repricing potential. Here's an idea. Consider looking at out-of-the-money call options on DCOM.
Okay. Expiration date.
Maybe expiring sometime in late 2025 or perhaps even early 2026. You want to give that repricing story time to play out and be recognized by the market.
And the outrageous part is?
The outrageous part is you're making a pretty leveraged bet that the NIM expansion will be substantial enough and recognized quickly enough to drive a significant move in the share price, making those OTM calls profitable.
And the plausible part? What makes it not completely crazy?
The plausibility comes directly from management's own numbers. They laid out the size of the loan book, repricing that $1.95 billion at 4%, and their own estimate of a potential 35 basis point NIM lift just from that first wave.
So it's grounded in specific data points from the call.
Exactly. It's not just wishful thinking. It's a directional bet specifically on their ability to execute on that stated NIM expansion potential. You're betting the market might be underestimating the impact right now.
Interesting angle. Leverage, directional, but tied to a specific catalyst they themselves highlighted.
Precisely. High risk, potential high reward if things play out as management hopes.
Okay, great stuff. So to wrap up our deep dive on Dime Community Bank's Q1 call, clear progress on core deposits, solid NIM expansion with a significant runway ahead thanks to loan repricing.
Plus, strategic hiring aimed at driving future growth, even if it means slightly higher costs near term. Credit looks stable for now.
Definitely key drivers to watch in the coming quarters. Remember, everyone, this analysis is purely for informational purposes.
And that trade idea, highly speculative. It is absolutely not financial advice. Please do your own thorough research before making any investment decisions.
What are your thoughts on Dime's path forward, that NIM potential? We encourage you to continue the analysis. Thanks for tuning in to TalkTickers.